Are you expecting a recession to come?
Right now, I would say no.
Why entrepreneurship?
I've been told I have an unhealthy level of risk tolerance.
What was that moment or something that told you that you can probably do this?
Without money, what you do doesn't matter.
You've mentioned regulation is alpha.
We are a firm that invests in a regulated industry.
What is something that you kind of understand about regulation that maybe other investors are not seeing?
We're not just taking bets on regulated industries. We are shaping regulated industries.
I kind of wanted to ask the first question before we get into the interview is that are you expecting a recession to come?
Um, oh, that's a good question. Less so now. Um, I think this time last year I was definitely expecting a recession. Right now I would say no.
Okay, okay, superb. Um, so first is I want to ask like, what was Michael as a kid? And what did Michael like to do? And what is the things that Michael was interested in?
Michael as a kid. Wow, that's a great question. Love being outside. Still love being outside. Oddly enough, I started my first business as a kid. Um, I sold ice cream up and down our street. Our neighbor had the ability to get ice cream at wholesale, and so me and uh, my neighbor, who was I think a year older than me, we started buying ice cream and selling it up and down our street. So I've always been entrepreneurial, always interested in taking risks like that. But I love the outdoors, love the water, um, and was always very happy.
How old were you
Oh,
when you
how
sold
old
ice
was
cream?
I? How old
Yeah.
was I then? I was, I think, 10 when I was
Oh,
selling
okay.
ice cream up and down the street. Yeah.
Okay. Okay. And from there, did you ever think that you were going to be an entrepreneur, or did you think that you're probably going to be somewhere in corporate?
I've always been entrepreneurial. In college, I had a business that I was a subcontractor. I helped flip apartments, and then I left an MBA program to go start a drive-through coffee shop. Um, left kind of big advocacy association to go start my own firm. Yeah, so I've always been entrepreneurial. I've always enjoyed working for myself and taking those risks on myself.
But why making? Why entrepreneurship? Is there any
Uh, you
reason?
know,
Was it there in the family or something?
no, it was not in my family. I've been told I have an unhealthy level of risk tolerance, so it could just be that. Um, you know, I get bored in a traditional job pretty easily. I don't think I've worked anywhere outside of working for myself longer than 3 years.
How does one kind of build risk tolerance, or like does it come kind of naturally, or is it something that is adaptable?
That's a great question. For me, it's always been natural. It's always been there. I've always been willing to take risks to make things happen on the other side. But I think you can build risk tolerance. I think venture investing shows people how to build risk tolerance. I think any investing shows people how to build risk tolerance. People will start in safer markets like mutual funds or a venture fund in my case, and then kind of grow into the more adventurous, picking individual stocks in the traditional markets, angel investing into individual startups in more in my world. And so, I think you can definitely build that. I think early success helps build that. Just like getting beat, just like getting bit, will make people less risk tolerant. And so I think that it works both ways. You can learn to be risk tolerant, but you can also quickly become risk averse.
Yep. I think mostly people probably when they're beat down, they probably quit more than come back. But I think in your case, I think that is what makes an entrepreneur, being able to take risks on different levels.
No, absolutely. That I think entrepreneurs take different risks every day. Whether that's big risks of betting on themselves and their team on their venture, but small risks they're taking every day to keep themselves afloat and active and alive.
Yeah, the reason kind of why I kind of wanted to ask this is because the entire your company and what you do is completely based on hedging risk, taking risk and hedging risk. Is
Yeah,
what
no,
is that? That's why I
absolutely.
kind of want to understand like where that came from. So I want to ask like you've spent about 25 years in government relations, right?
Hmm.
Before you kind of launched in 2024. What was the moment like you kind of realized that this was something that you can do on your own, and then in terms of not only like manage risk, but also something that you can invest and back behind it? Like, what was that moment or something that told you that you can probably do this?
Yeah, that's a great question. When I started mob advocacy, actually intended to raise a micro fund at that time. And I listened to some people who told me I didn't know enough about what I was doing to do that, and maybe they were right, maybe they were wrong. I don't know, but so instead of that, I built Mob Advocacy to really work with startups in early stage tech, and had tremendous success. We had founders uh, come to us and tell us, "Hey, you're really good at what you do." Um, the piece that kind of shifted my thinking from mob advocacy into Shield Venture Capital was the fact that after telling us how great we were, the next line was often, but we need money, and increasingly the line after that was, without money what you do doesn't matter, right? And so looked at what I was doing, knew I still wanted to help startups in early stage tech, and knew that in order to do that, it was going to have to raise a fund. It was going to have to be me. I was in a position to take some time off and divested from the firm and set out to raise a fund.
If you were to put it, what Michael does, how would you define it? In terms of, is it more in terms of understanding risk, or is it more in terms of understanding specifically regulated markets? Is it both of them? What would you define what you do?
I think it's both of that. I need to understand. I need to understand the markets in order to know what it is we're investing in. Um, and at the same time, I have to know and understand founders and their challenges to be able to help them. Uh, it's knowing those two things will allow me to both help founders and help our investors uh, make a solid return.
I want to get into the market here. So just help me understand and correct me if I'm wrong here. So there are about maybe 17 regulated markets. If you were to take all of the regulated markets, right from let's say healthcare all the way until AI, all of it, right? Maybe about 17 regulated markets. And the compound annual growth rate is about maybe 10%. Average is about 8 to 10% on each one of these. And most of it is, if you take for example the top 10, let's say healthcare, fintech, construction, energy, and all of these things until real estate, it's about a trillion a year, right? If you take the TAM of how big it is. The question is, how do you size regulated markets? Is it, do you take the TAM, do you take the budget? How do you size these regulated markets?
I think every market has to be looked at differently. So obviously, TAM is important. We need to see that there is a potential venture return out there. Um, but that said, how many founders get even 1% of their TAM, right? It's um, more importantly is to us is, hey, is there a pathway to get this company to 100 million in revenue, and what kind of moat, what kind of leverage do we have to build in order to make that happen? Um, and so it's a mix of TAM. The market has to be there to do that, um, and whether that's a current market or an expected market, we look 2 to 5 years into the future when we're investing, and so what the market looks like 2 to 5 years from now is more important than what it looks like today. Um, but can we leverage the market enough? Can we create a moat or a barrier to entry or some piece to help drive that company into 100 million in revenue? Because at that point, the optionality for that company is limitless. They've got a path to an IPO. They've got a path to acquisition. There's you know the paths at that point are so much easier than they are when starting out.
Right. Help me understand this 100 million, because I'm looking at this, like, for example, if we most of these regulated markets are kind of stable, right? Whenever, let's say, there is a new policy or something, that a new implementation that kind of comes out, it is usually either redistributing the existing slice, right? There is something that's
Mm-hmm.
coming out, or maybe it creates a wedge in the existing pie, right?
Sure.
But that would probably be the new TAM. Would that be the, I mean, for your market specifically, probably the addressable market? That would be probably the one that you'll probably evaluate. Is that a right evaluation?
Yeah, I think so. In regulated markets, sometimes you can look at the growth rate and say, yeah, that's what you're looking at, in terms of your market, and growth rate is is often the easiest to address for a startup. But you know, a good moat and a good leverage helps you eat away from that competition faster. So if you're not growing the pie at 10%, are you increasing your ability to compete in that marketplace by 10% or more? Are you in a position to better compete because um, in, because the regulation says, hey, batteries, just for an example, batteries have to be to this standard, and you might be the only one making them at that standard at that point. Or in healthcare, looking at compliance, you have to record patient data in a certain way, and you might be the only one doing it in that way. We look for those opportunities to create significant moats. So within a crowded space, we do the blocking and tackling that gives them some blue ocean to grow, because a startup, the only or one of the few operators in that space because of new regulation.
Right. Maybe let me ask the question in another way. So let's say, for example, you have gone with a moat. Let's say, for example, you want to make 100 million with this company, right? That's your end goal of doing it. But let us say maybe that space, for example, there's already a competitor who's kind of doing it. And the new policy regulation maybe kind of says that this is how the new thing kind of needs to be done. And maybe it's a small change for them. Maybe it's somebody, an existing player, who is probably going to do it. So if you were to enter that market, let us say, and if how would you find out that there is enough for all of, including the competition? How do you factor in the competition, saying that this is how big the market is? When this policy comes out, it'll open up this wedge, and this is how we get a piece of it.
Competition is a big part of what we look at. um, it's it's a major factor in our market research. What we look at more, however, is um, h- how how big is your differentiator, right? So we look for differentiators that are orders of magnitude different from existing policy. So it's not, you know, cheaper, faster, better by a small margin, which will create a small bit of the ability to capture the existing market. We look for orders of magnitude different. Um, a completely different compliance structure, a completely different way of doing something. Battery technology that's not widely available on the market. Nuclear fusion and helping that become its own industry. Um, Healthcare and AI looking for data sets that are going to differentiate a startup from the market, looking for somebody that can have 10x the data by the time they hit the market than anyone else out in the marketplace. And so we look for orders of magnitude of difference. It's not just little differences we're looking for. We're looking for big differences.
Got it. So you're saying that you need to have, let's say, at least 10 to 10, 20 miles of head start. That is where you kind of even bet on. That's where you kind of even invest in. Is that a good estimation to say?
Yeah, and I think most venture looks for big changes, but because of the spaces that we play in, we look for orders of magnitude differences. Significant. This is significantly different, significantly better than what's being done before, so we can drive compliance towards it, and make it be kind of not only the market leader but the market mandatory option.
Very relevant. Which regulated industries do you invest in? Is there a specific one or two that
So our firm thesis is kind of evergreen in terms of we invest in pre-seed startups in markets shaped by policy and regulation. As we go from fund one to fund two, and then eventually on to fund three, the 6 or 7 primary focus industries may change. I don't think they'll change a great deal. I think healthcare, energy, and clean tech are going to be active for a long time. AI and quantum computing are certainly going to be active for a long time. Um, but some of the more periphery areas might shrink a little bit, and we haven't gone through the motions of figuring out, hey, what are the 7 or 8 areas we're looking for at fund two. But in fund one, um, healthcare, energy, environment, transportation, AI, space, were primary industries that we knew we wanted to invest in, going in, and then we plotted kind of how are we going to find the best companies within those markets, um, to drive returns. Um, so we're looking for the best in each vertical, um, to drive those returns, as opposed to looking at the best, three, four, five, six healthcare companies, and then the best 5 or 6 financial service companies. We're looking for the best of the best across a wider range of industries, and I think that gives us an advantage, in terms of creating a return for our investors.
I want to get your take on the sizing of the AI market right now. I was speaking to Shane. He's a VC in Seta Capital, and he was asking him that what are the characteristics that you look for in a company that will survive the AI bubble, right? So right now it's about a 20x valuation for each one of the company, and I was asking him like, what is that you're looking for? So he's telling me anything that replaces knowledge workers, right? Anything that is maybe low context, high switching box, that is where probably I'll probably put my money on. What is Michael's bet? What are the characteristics that you're looking for in an AI company?
So I think there's two things that we look for. One is compliance. I think AI and compliance go hand in hand. There's a lot of pieces that you can take off of a worker's plate, or replace a worker, with a sensor or an easy way to pull in data. You kind of machine reading camera or machine learning cameras, different pieces, and so I think that is one thing that we look for. How do you automate compliance? That's certainly a big piece. And the second piece is what is building your AI, and so we look for data sets out there that are going to help that company build a moat and compete in the marketplace. Um, looking for uh, you know AI and diagnostics, especially visible diagnostics, reading X-rays. Um, if you have that, if you have the biggest data set, you bet that your machine learning model can do that better and faster than anybody else. And so if you have a large unique data set, um, you should be able to compete if you have enough patient data to be able to build different models on. And if it's unique from other organizations, you should be able to have the data to compete on. And so we look for compliance opportunities and we look for data opportunities.
So data set is the biggest moat on regulated markets. That will probably
It,
will move the needle.
in healthcare, especially, yeah.
You mentioned regulation is alpha. Can you please explain what that is?
So regulation as alpha. So we specifically look at regulation where we can drive growth. We knew we wanted to invest in nuclear fusion when we started the fund, and so it was still, it was a year before Congress passed a bill that said they're going to regulate fusion differently from fission. Certainly the right decision. And I think that opened some people's eyes to investment, but I think they soon realized that there are a lot of other steps that go before regulatory clarity comes to that marketplace. And so we are hedging our bet on a specific company that we think can get to the marketplace fast, that has that has some unique off ramps in terms of revenue opportunities. And so where a lot of other venture capitalists are see fusion and see, hey, it's not ready from a regulatory standpoint, and they're right. Um, we have the ability between my experience and our team's experience to help shape what that regulatory outcome is going to look like on the other side, and make sure it's a positive outcome that can help drive growth. And so it's you know we we're not a firm that invests in a regulated industry and hope for the best. We are a firm that invests in a regulated industry, one that we know how to operate within, and actually drive outcomes that are positive for our portfolio companies and that are going to drive growth at the end of the day. And so it's we are a hands-on strategic investor, and it's not just a check that makes a difference for us. It's the ability to both write a check and make sure that uh, we believe that we've got a more than good chance of impacting that regulation outcome.
Right, but like, what is something that you kind of understand about regulation that maybe other investors are not seeing? I'll tell you two things because it is not just about the money because the entire game in which you are there is that you need to understand risk. It is not only to take risk, but to understand risk and what is the consequence of that risk. And I want to talk about the multiple stages in which it kind of goes through. But I want to understand what is something that you understand about the regulated markets that most of them miss.
Uh, you know, how, I understand how a company can operate and work to change those regulations, and that's the basis of Shield Venture Capital is that we're not just taking bets on regulated industries. We are shaping regulated industries, and we're, you know, our founders are the people that are going to win at the other end. And so, it's not just, hey, what are the chances of that this regulation changing? What are the chances of this regulation changing to X, Y, or Z? It's how can we make sure X happens and Y and Z doesn't happen? And that's an important part of our investment decision. Not only is there a regulatory path, but do we feel confident that we can impact that regulatory path in order to drive growth on the other side?
But I want to ask in terms of like, um, how do you have a way to calculate this risk? Do you come to a number that says that there's a, because to some extent it's an eventuality, right? You're betting on the event to hacker. That is when the entire product will kind of take off from there. So do you put a number on it? Do you say that there is a 60% probability that this might happen and that this might not happen? Right. How do you kind of come to that? You don't have to give us like the exact thing, but like how do you kind of ballpark it?
Um, so I've been a lobbyist for 25 years. Our One of our venture partners was a former New York State senator, still very active in the policy space on the clean city side. We've got someone who worked in healthcare, both on the Hill and at the administration level. Um, so we've got decades of policy experience, and so you know, that that kind of history, being able to say, hey, you know, I know the players, I know what can drive them, what they're not going to be moved by, who is movable, um, and then at the end of the day, what is it going to take to get from A to B to C? Um, you know, it's it, we just kind of sit around and kind of ballpark it. You know, it's sometimes it might be 25%. But if you hit that 25%, it's huge. Sometimes it might be 80%. Um, and there's no right or wrong answer, but being able to properly diagnose that risk number is huge for us, and so it's a calculus that goes into every investment memo we write.
Okay. Um, I want to get into the different stages of policy that comes to kind of pass, right? Right from let's say legislation, rulemaking, and then post process after all of those things, it takes about 3 to 7 years. Is this the right amount of time that it takes for anything to come out?
I think generally, depending on, are you looking federal, state, local? Federal always trends longer. State and local can trend a little shorter. We generally say 2 to 5. Um, if we're looking at a 7 year regulatory outcome, we've got to make the decision that, is that the right fit for the fund, because the fund is a 10 and 2, right? And so if it's in year one of the fund, maybe we can take a risk on a 7 year regulatory cycle. If it's in the fourth year of investment, probably not taking that chance.
So when at what stage of the policy do you kind of invest in? Let's say, for example, is it if it's at the statute or if it's at proposed rule, final rule, implementation? When do you actually invest in saying that this will go through, or do you do it way before this even?
We are usually not always, but usually before um, a, a a bill or legislation or kind of a regulated rule change notice is out and live. Now that's not always the case, um, and sometimes the regulation, especially at the federal level, legislation and regulation at the federal level take, generally at least 2 years, as many as eight, for a bill to pass in terms of number of Congresses in states. You're talking. I've passed bills in 90-day sessions, and your regulations tend to happen in can happen in 90, 100, certainly almost all within 360 days, and so we are usually, before any change happens, we look for we look we look when people are starting to think about what needs to change to help drive markets, and so we're almost always well before legislation and regulation actually occur.
Okay. And does this playbook apply across all industries? The same strategy, the way you do for healthcare, fintech, or is there any changes?
I think there's certainly tweaks based on the industry, but the 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 playbook is generally the same. Kind of understanding the lay of the land. Kind of knowing the players. Um, Having a deep dive into what those regulation opportunities are. Um, Having a strong understanding of not only our proposed solution, but what are the alternatives and the pluses and minuses of those, and then figuring out an action plan to get to the outcome that we want. And so tweaks, if there's tweaks, they're often going to happen in that action plan. And so you know um, it might be a media blitz. It might be a quiet regulatory approach. It could be anywhere in between, based on the regulatory outcomes we're looking for, and uh, what that market looks like in terms of the ability to move people. But the groundwork, that homework piece of understanding, having a strong understanding of the market that we're dealing with, that always happens first, and it's got to happen in order for us to formulate that strategy to get from where we are into where we want to be.
Okay. And you mentioned that defense supply chain and battlefield energy are like overlooked categories. Why are they overlooked?
I'm sorry, can you repeat that?
Look, for example, you pointed like, for example, defense supply chain infrastructure, battlefield energy. These are overlooked categories. Why are they overlooked?
Why they're I think they're overlooked because people uh, don't understand how to determine what the risks are in those spaces. Um, I think they're overlooked because they're less developed, they're less popular. Uh, as more startups grow in that space, and there's more data for people to evaluate that risk, you're going to see uh, more investment in those opportunities. And so, usually a market is overlooked because people don't understand it. Kind of going back, looking at rideshare or telehealth. People didn't really understand them, and didn't understand how to evaluate the risk, what's actually going to happen there, and those industries are the same way right now. They're leading edge. They're not popular in the startup space. Like investment starter founders go to markets that can grow faster and get capital. Um, and so as those markets mature, as the regulatory clarity comes, um, as the as in the battlefield piece, as the military knows what it is they want to invest in there, the clarity will come, and our job is to know what what those winners are, and making sure they get the exposure that they need, uh, in order to really be winners on the other side.
Are they investable now, or they were they investable like even 5, 10 years ago?
Um, 5 years ago, yeah, I mean, it depends on it. It depends on your risk tolerance, right? It's uh, 5 years ago, far more risky than now. 5 years from now, far less risky than now. And so, what we think is investable is not what other people think is investable. And so it's hard to tell. It all depends on what your risk tolerance is.
Right, right. At what point in the chain kind of does the investor kind of see the ROI on the investment itself? Because it's about the regulation itself takes a lot of time. So when do they kind of see it?
I mean, so some of that depends on the market that we look at. Our first investment in vanadium was able to show growth faster than we thought. And in terms of building a portfolio, we look at a mix of things. You don't want everything to take 7 or 8 years. You want some things that you think will will sprout early. And so it depends on the market. It depends on the technology. Um, I can tell you with AI, it seems to be taking less time to go to market in regulatory markets, in regulated industries than it has in the past. Some of that is due to improved regulatory landscape, in for instance, permitting, and right now, some of that is because compute is going faster and people can build faster, and kind of reach places that they couldn't reach 2 or 3 years ago. Uh, but I would say it's faster than I would have thought when I was planning all this together, but it's still mostly in that 5 to 7 year range for real returns to happen.
Yeah. Yeah. And I want to ask in terms of your portfolio of your current companies that you've invested in. What captures your thesis the best? Like, what is something that is there in your portfolio that you're really betting on that this is going to be the next thing?
Yeah, that's a good question. I think honestly, I think there's three companies in our pipeline um, that are really at the essence of what we do, and um, can't can't really talk broadly about them. But um, we when I started the fund, I said I would work in any heavily regulated industries, but pharmaceutical, because the FDA rules couldn't be changed. And lo and behold, I was proven wrong, and we are going to take a chance on one pharmaceutical company. Battery tech and grid resilience. The ability to create microgrids, and the ability to connect to the grid faster is making these technologies uh, more valuable. Um, and then there's a company in the police tech space that, legislation. There's a couple bills that happened here on the East Coast that we expect to spread across the U.S. That's going to allow them to be, um, the primary player in their space. And so, I think there's three pipeline companies that show, whether it's legislative, regulatory, um, changes can really make significant changes, um, and they're happening faster and more frequently right now than ever before. And so it's a good time to be where I'm sitting in terms of opportunities. Um, but yeah, so in terms of pure thesis play, those three pipeline companies are are really pure pure Síol thesis plays. I think uh, our five investments are all on thesis, and but they're it's harder to see in terms of exactly what those regulatory changes were. Um, that are going to happen. Some of it's because they haven't happened yet, and some of them are more subtle. And so it's if you're looking for, hey, here's an example of company change outcome. Those are the three that are probably the easiest to point to and say, this is exactly what happened.
Right. Usually, when VCs invest on any companies, there is a fair amount of research that goes into the idea itself, the product, the market fit, and so on and so forth. Right. But in terms of regulated markets, is there anything different that you do in research, or do you go by your gut feeling of like, I know this will happen, I know this will not going to happen because I know what is going to happen in the government, right? So,
Yeah.
is there a difference? Yeah.
Um, you know, even though I think every lobbyist likes to think that they know what's going to happen. We're still wrong sometimes, but so even though we've got an idea of where this can go, we still look for you know we look for policy market fit, right? So it's not just product market fit. We do look and make sure that the policy is the right fit and the market is right fit for the investment that we're looking to make. And so that's we call it policy market fit, but that's part of our investment criteria.
Right, but how do you do? Is there any different research that you do it, or do you do anything different rather than a regular investment research?
Um, I mean, probably. We go deep into into regulated trade mags. We look at federal, state, and local legislative and regulatory scans. I'll look at legislation going back 15 years. I'll look at regulations going back, probably close to 10. So we get a really good read on what has happened over the last 10 years, and in order to have an idea of where that's going to go. And so um, I still use a lot of my lobbyist skills in terms of evaluating markets and where they're going to go. So we're researching legislation, regulation. We're reading deep into old kind of regulatory trade magazines and articles. So we'll do deep dives on the regulatory side, probably more so than anybody else out there.
Do you ever invest in something like, I think that's a very important point in terms of research, what you've done, right? Do you invest in something like, let's say you have a product and you feel that this product is probably going to be differentiated, but there is no such evidence to back that the policy is probably going to change anytime soon to facilitate the product, right? So there is no, absolutely no tailwind right now. Would you put your money there, or would you maybe wait until there is at least some tailwind and then maybe bet on it?
I mean, that's a good question. I think it would depend on the opportunity. Would I do it? Probably. If it was the right opportunity, is it you know even if there's no regulatory structure for it currently, is it something that should exist? And if it should exist, there's a higher likelihood that the regulatory outcomes will come. Um, you know, it's 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 there now, but 10 years ago, um, you know, we we would have looked at drones and kind of urban air transportation. You know, even before the FAA had started to write rules. Well, 10 years ago, they'd started to write rules. But knowing the potential growth in that space, even without the knowledge that the regulatory framework was there, or even had any interest in being built, we would have invested knowing that we could help make that happen. And so, the regulatory framework doesn't have to be there in order for us to invest. Um, we've got to get through people's minds and hearts that this is something that should exist, and how do we make it exist? And so um, there's there's a lot of regulatory work that goes into making that happen that I think is underappreciated. And so in certain regulatory markets, um, I think we'll be ahead of the curve when those come.
Okay. Um, Evaluating the product to some extent, I think plays a very vital role. But in terms of evaluating the entrepreneur himself, right, or himself or herself, when we are kind of evaluating the entrepreneur, do you what do you look for in that? Because I think they need to be in the regulated space for some extent, because that is when they kind of understand the product market fit, or to some extent the pain point of the customer, the end user, right? So what is something that you look for, or your capital looks for when you are investing in an entrepreneur?
Definitely prefer people that have real experience in their space. Um, it's so much more helpful. Um, when I started working with with founders, we ran into a lot of different healthcare companies, and um, they weren't run by people who understood healthcare. And so I would ask them, what's your business plan? How are you going to get paid? And they would always say, well, the consumer's going to pay us. Um, and it, they just didn't have an understanding of how healthcare works in this country, and I think that's problematic. I once had a founder told me that they were HIPAA adjacent, which scared me enough that there was never another conversation after that. And so having an understanding of of your healthcare space is certainly helpful. Is it mandatory? No, but it's certainly helpful. I would say, um, well, in our case, everyone, yeah, in our case, all of all of our founders do have that experience. Um, and then you look for the same things as I think any other VC looks for, kind of resilience, um, coachability. It's a marathon, not a sprint. You look for people who are up for that challenge.
I want to talk about the competitors in the space, right? Like, I think, let me tell you two things. First thing is that when I was kind of researching about the space, and this was something I've heard. This is the first time I'm hearing about people betting on the policy itself. It is, for me, this is kind of the first thing, because I think the space itself, if you take a look at the other competitors, let's say for example, Founders Fund by Peter Thiel, or Lux Capital, Shield Capital, all of these funds, right? I think most of them, if you take a look, specifically, let us take for example defense contract, right? From 2020, it was like around 1.6 billion, and now it's about 15 billion in terms of money that is being invested. So this is kind of growing every 9 months, kind of doubling every 9 months, is what I kind of researched on this one. Is there a moat that you invest in that others don't, or are they joining in late? Because you kind of started this in 2024. which is pretty close to a prime time to kind of enter the market, right? Is there something that you do as a as a fund that others probably don't do?
I mean that's a good question. When you look at money going into defense, defense tech, uh, that's venture following the money. The government spending went up, wars were happening, tech, uh, leading edge tech was being used in the field, and people were there to invest in it. I think it's not much different than my guess is 6 years ago. There was probably a boom in clean tech i- investments because that's where government was spending dollars, and that's part of our analysis is where we are when we're investing now. um, most of our investments are a year away from really hitting the market in a broad way, maybe 2 years away from hitting the market in a broad way. So what's that market going to look like 2 years from now? Is the same spending going to be there on defense tech? I don't know. 2 years from now, we'll be looking at, we're going to be on the precipice of another election. We'll have a better idea of the future of the country. Um, but we've got to bet now whether or not we think is defense tech in a boom for the next 2 years, for the next 6 years. I think AI is easier. AI is going to grow over the next 6 years. I don't think we know what it means for the country yet. Um, but I'd be surprised if that bubble popping was less than 6 years out. Now, will does that mean success for everybody in the AI field over the next 6 years? No. Um, there's still going to be small bubbles bursting in different spaces. But I think overall, it's an area that's going to continue to grow over the next 6 years. And so you're looking at when you're looking at making those bets today, what's that going to look like? Are we going to be spending the same in defense tech over the next 6 years? Are we going to be spending the same in space tech? Are we going to be spending the same in clean tech? Or are they areas that are going to grow or shrink? That's part of what we have to figure out as investors. That's why our investors pay us to do those kinds of things.
So it's not like a regulatory inflection or like hype or anything. It's just that it's reacting to the market. Whenever there's money to be invested, you're trying to take a bet on. Is that what it is?
Yeah, I think we try to be ahead of. I think we try to be ahead of the money. Um, but when government spending in an area jumps that significantly, um, the money's going to follow. Now, you've got going hand in hand with that. You've got a military right now that is actively working with venture capital to help de-risk their investments. Um, and so you've got a Department of War right now that is very open to venture, and bringing investors in and showing tech that they're looking at, and that tech has a path to viability because of a government contract, or it's gonna a subcontract, or another reason. So you've got DOW doing the things that you saw DOE do during the Biden administration, right? And in that, reaching out to investors and showing them tech happening. A lot of this usually Yeah, a lot of this existed previously. It was just harder to find. You could always go to a national lab and look at what tech they were looking to spin out, or go to a university and talk to um, their commercialization teams and see what was being spun out. In this case, right now, the DOW is actively looking for investing partners for different tech that they're looking at. So it's I think some of the growth is just following the money, and some of that growth is because DOW is actively inviting more people to the table to see what it is they're funding that somebody else might be interested in writing a check along with them.
Perfect. Sounds good. I just have one last question. Where is
Sure.
the next valley of doubt? You mentioned about the value. Where is the next one? And where nobody is maybe paying attention to?
um, I mean that is a great question. I think there are a lot of people paying attention to these areas, uh, but they come with a lot of risk. And so I think space certainly um, is on that horizon, and then quantum. So I think a lot of people are looking at it. A few people are fewer people are brave enough to invest in it. Most people are waiting for the right signals that say, hey, the valley of doubt is shrinking to the point that it makes sense to get in. Um, and so I think those are certainly two big areas that I would look at right now.
What do you think about SpaceX's valuation?
Um, I think it's overvalued. Um, yeah, I think it'll come down to about 100 before the end of the year, which is still a great company. It's still a great valuation. But I think the initial hype is going to die down a little bit, and it'll come back to earth, for lack of a better word. Um, but I think they've got great tech out there. It, just carrying that valuation that long, I just don't see it's I don't see it's I don't see it happening personally, but I could be wrong. That's why I invest pre-seed and not IPOs.
Right, but you eventually wanted to go to an IPO, right? Most of your companies you wanted to go to an IPO.
I mean, we want good exits for our founders and our investors, whether they go to IPO or exit a different way. That's not it's not my decision to make. I think most times a good exit, founders and investors are all going to be happy. Um, and if we end up with good exits, we've done our job. So whether they hit IPO or not, I'm sure some of them will, but it's you know
Do you invest in pre-seed, seed, or any of the series, or just seed?
so we do pre-seed only. We are pre-revenue, pre-product up to 1 million in revenue. So I think we're try to be a pure pre-seed um, fund out there, and so excited excited about the very early, the from 0 to 1, from 1 to 10 space, and making sure the legislative and the regulatory issues are handled in that time, that when they get to 10 and want to go from 10 to 100, they're ready. That's our job as pre-seed investors.
Perfect. I don't have anything else, Michael. Thank you. Thanks a lot. This was a great conversation. I understood a lot about the regulated markets. But yeah, thank you. Thanks a lot.
Hey, it's my pleasure. It was fun.
Yep.
Thanks.